please join me in welcoming Tim Baker.
Thanks, Sarah. Good evening, everybody. Thank you all for taking time out of your day to come here. I have a couple of preambles. First of all, if I start shouting, I'm not shouting at you, I'm shouting to you. I started this business after 22 years on Wall Street, learning a lot about the business and what goes on in the industry, and a lot of it doesn't get shared with you, investors, the clients, right? And actually, I think there are a lot of places where the investor just kind of falls by the wayside. So before I get started, I'm going to give a little bit of a quote from a book that I ordered and actually just showed up yesterday. But along those lines, and I was talking to Sarah about this before everybody got here, I want to make sure like what I'm saying tonight doesn't come across as necessarily negative. I'm just trying to shine some light on things that generally don't get shared with traditional investors. So for any of you who saw the invite that we sent out, I said there are massive changes that are going on in the industry. Most of these things are not being talked about, right? And so if they're not being talked about, and the companies that I used to work for, my job was to go out to other advisors, other financial advisors, teach them about these things so that they could go and teach their clients about them. And as you'll see from some numbers I'm going to throw up on the slides, that's not happening, right? So the whole purpose behind me starting my company was, well, if you're not going to do it, I'll do it. I'll take the message directly to the investor. So that takes some time, and it's challenging because it's new, it's different, right? So I'm not going to get up here and tell you to buy American funds, right? Which is what a lot of advisors in my industry will do. I don't know much about investing. I'll create a financial plan for you, and we'll just put the money in mutual funds. How many people here own or know what a mutual fund is? Should be just about everybody, right? How many people here know what an ETF is or own an ETF? So maybe 4. We're narrowing it down. How many people know what smart beta is? 0. How many people know what factor investing is? 2, 3, and 1 because of many conversations we've had, right? So that's the whole point was, am I going to learn something tonight? We've just established that the last 2 things, very few people know anything about, right? And that's a problem for investors. And that's why things still stay expensive. So that's kind of my preamble. The one thing I would say is I think people worry a lot about dumb questions. I view questions as a sign of intelligence. So anything that comes up on a screen or that I'm saying that requires clarification, one of my biggest faults is I've been doing this for 22 years. So I just start talking and rambling and saying things that are perfectly clear to me that might not be clear to you. So raise your hand, throw a shoe, something. But so the quote I wanted to start with, the book is Where Are the Customers' Yachts? Right? So everybody on Wall Street, how many people here has seen the home of a hedge fund manager, right? Or their cars or their boats, right? They make a lot of money. Does anybody know what the term 2 and 20 means? Right? So if you give $1 million to a hedge fund manager, they'll charge 2% on that $1 million, and then whatever gains you get that they generate, they'll take 20% of those gains. I'll do my best not to swear tonight. Like, that's remarkable that that's even allowed to happen, but it's allowed to happen. And by the way, hedge funds don't have a lot of disclosure rules, so you don't always know what they're doing. But the quote from this guy, and I haven't finished the book yet, I was intrigued just by the title because it has a lot to do with sort of why I started my business, where most people will find every opportunity they can to take another dollar out of your pocket, right? Where else can we charge some fees? And I'll talk about that a little bit later. I'll always take every opportunity to put something back in the pocket. In fact, one of the things I'll talk about at the end is how many people here own a Vanguard fund or know who Vanguard is? Right? Vanguard's massive, right? What does Vanguard do every year? Right? As their funds get bigger, they do what to the fees?
Decreasing.
Lower them, right? They're owned by not their shareholders, they're owned by the people that own their funds. They're a mutual company, so it's beneficial to everybody for them to lower the fees because the investor pays less and performance gets better. So the quote, and this is in the introduction, does everybody here know who Jason Zweig is? He writes for the Wall Street Journal and Money Magazine, and he wrote the intro to this book. The names and faces and machinery of Wall Street have changed completely from Schwede's day, but the game remains the same. The individual investor is still situated at the very bottom of the food chain, a speck of plankton afloat in a sea of predators. So, with that, I will again say I don't want what I'm saying to come across as negative. These aren't bad people. They're just in an industry that's built to pay them a lot of money and take it from the average investor, right? And if you're an institution, if you're a very large investor, you're still at the bottom of the food chain, but people will cut their fees in order to get your business. So you fare a little bit better, but not a ton. And by the way, things have gotten better over the years, and we'll talk about that, but the education is not there. So, you know, one of the things I put in the invite was, why aren't these things being talked about? First of all, money, but second of all, education. There are just a ton of people out there that don't know what it is, and even though they've been educated on it, they don't understand it. Some of this stuff will come across pretty technical. I'm doing everything I can to try and bring it down. You know, we won't do T-stats and other statistical measures. We'll try and keep it. But if anybody wants to dig deeper, I'm happy to do that. So the current and future state of investing. Brief history. So, right, go back to the very beginning when all the profiteers started on Wall Street. You basically had stocks and bonds, right? Does anybody know what the first stock was to trade on the New York Stock Exchange? Standard Oil.
General Electric.
Not far. General Electric was actually pretty far down the line. It's a bank.
JP Morgan?
Nope.
Wells Fargo.
Where's Wall Street? Bank of New York. So, by the way, I had to look that up too. So that's stocks. Then you had active mutual funds, and they came along in various forms along the way. But right, somebody came along and said, "You're an investor. You don't know how to pick these stocks. I'll pick them for you, and I'll charge you a fee, and I'll wrap them in this thing called a mutual fund." So the very first one was Massachusetts Investors Trust. For those of you that pay any attention to the investment world, that is now MFS, which is a relatively large mutual fund company in Boston. And they would buy things like, I went and found all the, this was kind of cool, all the old logos. Like, that's the original logo for Coca-Cola, right? So nobody would recognize that. But if you wrote any word in the what is now known as the Coca-Cola logo, you would know that that was the Coca-Cola logo, right? International Business Machine's pretty far cry from what it used to be. But that's how it came along, right? And think back to the very beginning. Somebody said, "You don't know how to pick stocks, I do." Why? Why do you know how to pick stocks better than I do? Why do you know how to guess things better than I do, right? I'll come back to that. But that's how it all started, and it just sort of, and right back in the day, people went, "Oh my God, here's an expert. I'll pay him whatever he wants." Does anybody know what the original front-end load was on a mutual fund, like going back to the 80s, 70s, and 80s?
10%.
Close to it, 8%. 8%. So if you gave somebody $100,000, the next day, that was worth 92. Again, I'll do my best not to swear tonight, but that is unbelievable. And there are still mutual funds out there that have 4.5%, 4.75%, 5.5% front-end loads. Nobody uses them anymore because people are getting smarter and just walk out. So later, somebody came along and said, well, if these guys aren't really better at picking stocks, right, and can't do much better than the market, right, like the Dow Jones or the S&P 500, whatever it is, then why don't I just make a fund that tracks one of those indexes, right? So instead of having a professional manager, you just have to have a trader that says, "Give me the index, and I will buy the stocks in this fund in the exact same weights as in that index," right? So does anybody know whose brainchild this was? John Bogle, right? Our friend who is being somewhat ignored by Vanguard now. So that's the company he founded, right? First index mutual fund is Vanguard. And he's getting louder and louder with his opinions as he gets older and older. And he's kind of bashing ETFs, which is a massive business for Vanguard. But he had a really nice interview recently. But, right, what do you think the first index he tracked was?
Probably the Dow or the S&P. One of the two.
The Dow is, and we'll talk about that a little bit later, the Dow is kind of this index that I wish CNBC would just take off their screen, right? It's 30 stocks. Who cares what the Dow Jones Industrial is doing, right? The S&P 500 is a much broader basket of stocks, although we should probably spend some time, and I want to be sensitive to time because I just told Sarah, like, I'm always worried that I won't have enough material and then I ramble on until I'm out of time at the hour mark. But what the S&P 500 really is. So I assume we've all noticed that the S&P 500 has gone on quite a bit of a ride this year. Very nice January, awful February, great summer, hitting a peak in August, and not so great lately, as our president has talked about tariffs. But I caught an interesting statistic on CNBC the other day, and they had said when you looked back at August, when the market was at its peak, 99% of the increase in the S&P 500 was driven by FANG stocks. So Facebook, Apple, Amazon, Netflix, and Google. 99% of the return. Think about what that means for the person that goes, I don't know how to pick stocks. I'm just going to buy the S&P 500. I'm going to go buy this ETF or index mutual fund because I don't want to play with any of that stuff. From a returns perspective, you only own 5 stocks. 99% of your return was driven by those 5 stocks. So you own a basket of 500 stocks, but it doesn't matter, right? So the composition of the S&P 500 is important. So much later, there were ETFs, exchange-traded funds. So the primary, and there's a massive lack of education here as well. Exchange-traded funds and mutual funds are very, very similar. They were both created under the Investment Company Act of 1940. They're both open-end funds. The only difference, or the primary difference, is that mutual funds trade with daily liquidity. So when you buy or sell a mutual fund, you pay or get the net asset value of all the stocks or bonds, whatever it is, in that portfolio at the end of the day. An ETF trades on an exchange like a stock. So it's what's called continuous liquidity. You can buy and sell it all day, which is, that's what gets people into trouble. But so they're primarily indexed, and that's another massive structural feature for ETFs, is they have something called a create and redeem structure, which is fairly technical. But basically it means if I run an ETF, if I'm buying and selling all of the stocks in an ETF portfolio, S&P 500, whatever it might be, when I want to sell the stocks, I don't actually have to sell them. I can put them in a basket, all 500 stocks, let's say for the S&P 500, and deliver them to what's called an authorized participant. JP Morgan, Goldman Sachs, any of these big banks that act as an authorized participant. So no transaction took place. It's called an in-kind transfer. All I did was give them the basket of the securities, and they delivered me back a share of the ETF, so there's no transaction. So ETFs generate very little in terms of capital gains. Mutual funds don't have that luxury. So when a mutual fund manager sells stocks, sells shares, bonds, whatever it is, to make an investor whole, somebody who sells a mutual fund, that kicks off a capital gain. Right? So if you get a 1099 at the end of the year and it's got capital gains on it in a mutual fund, it's because that mutual fund manager was selling. And I'm going to come back to that because that's really important, especially nowadays. So first ETF, anybody know the company?
State Street.
What, are you an advisor? Oh, okay. So far you're like 100%. I got to watch this guy. So State Street, so I'm sure you know what the ETF is, right? Track the S&P 500. It's SPY. And actually, ETFs, well, I won't spend too much time on this, but ETFs are interesting. SPY is one of the most expensive Standard & Poor's 500 ETFs you can buy, but institutions love it because it's big, it's liquid, it has all kinds of options and derivatives that trade on it, so institutions can kind of play around with it, whereas individual investors just look for the cheapest one, which is actually now Schwab, who has gotten into the game with, if you know, sort of the big three ETF players are State Street, Vanguard, and BlackRock through iShares. So that was kind of the original. So if you look at it over time, the evolution is starting to accelerate. And I think a lot of it is based on investors are getting more educated, they're getting much more cost conscious, right? And there's massive, massive, massive competition, which I'll come back to then, why that competition is coming back, is taking place. So 1792, Bank of New York was listed. 1924 was that first mutual fund. 1975 was, by the way, they called it Bogle's Folly. When he introduced the first index mutual fund, they called it Bogle's Folly because it was going to kill him. It was going to break him. It was going to bankrupt him. It was the dumbest idea in the history of investing. Anybody know how much Vanguard has under management now? About 6 trillion. So they're right around the size of BlackRock, right? So obviously not a bad idea. 1993 was the State Street Spider ETF, and 2000 was the first smart beta ETF. And we're going to talk in a minute about what smart beta really means, because it means something very, very different to me than it does to everybody in the industry. And it's kind of near and dear to my heart, because my role at BlackRock when I worked in the iShares business was in the smart beta group, where we spent all of our time on factors and not what the industry calls smart beta. But that is what the industry would call the first smart beta ETF, would be the Russell 1000 value in the year 2000. So why isn't all of this necessarily good, right? So in the beginning, as I mentioned, Vanguard, iShares, and State Street were your big ETF players. Everybody knew it. If I want an ETF, I go to one of these three players. And what's happening now is so much money is flowing to ETFs that everybody wants in. And this is just a fraction of who's playing in the market. So all of a sudden, all these traditional players that run active mutual funds, right? So Vanguard, iShares, and State Street, now JP Morgan, Goldman Sachs, Fidelity, Direxion, everybody is getting into the game, right? And they're all going, I need to run ETFs. So what does that do? That lowers costs for investors. What does that do for companies like BlackRock? And well, I'm going to leave Vanguard out of that because I actually think Vanguard's really well positioned. So if you think of a traditional index like the market, like the S&P 500, that's a commodity. So I think that's 3 basis points now, 0.03% at Schwab. If I do something like a value ETF or growth or factors, which we'll come to, I can charge more for that. I can charge a premium for that. So BlackRock, which is a traditional active firm and runs things like a global allocation fund, the management fee on that global allocation fund is 0.75%. The total cost of the iShares Russell 1000 value ETF is 0.2%. That's not good for BlackRock's revenues. So what do they have to do? Right? Do the math on 0.75 to 0.2. How many more dollars do you need in the 0.2 asset to make up for the loss of the assets in 0.75? And there is a loss going on there, as we'll talk about. But so they're good for investors, but that product proliferation and differentiation can be very confusing. Right? So what is a Russell 1000 value ETF? And how is that different from an S&P 500 value ETF, right? So it's just more and more players coming into the space right? And trying to differentiate themselves when there may or may not actually be some differentiation. Yep.
Can an individual investor go with the Russell?
Yep. Yep. You can buy that, I believe the ticker is IWD. You can buy that ETF. It's big, it's liquid, it's safe, and it costs you 20 basis points, 0.2%. Very, very cheap. Yep, you can buy those things. But not a lot of people are talking about them, right? So most investors, most advisors are not sitting down with their clients and saying, hey, let's talk about smart beta. Let's talk about factor investing. So this is basically current state of affairs. I'm going to come back to that point in a second. With all of the talk of ETFs taking over the world, you'd be forgiven for thinking that mutual funds were dead. Here's the assets in active. Forget about passive. Forget about index-based mutual funds. Active mutual funds, if you can't see that number, it's $25 trillion. $25 trillion compared to passive mutual funds, under 5 trillion. Active ETFs, almost nothing. Active ETFs, again, you think about active mutual funds, that's the one with a portfolio manager sitting on it, guessing which stocks will do well. A lot of people in the industry think the word guess is pejorative. I think it's spot on. And a lot of people get paid a lot of money to make guesses with, little books like 10Ks and 10Qs in front of them. And passive ETFs, which has quickly eclipsed passive mutual funds at around 5 trillion. So active mutual funds are by and large the lion's share of what is held by investors today, which is not good for a couple of reasons we'll come back to. So we'll take a little bit of an intermission because I want to talk about what smart beta is, because it's key to everything else. Does anybody here know who Morningstar is? Most people? Morningstar, for those of you that don't know, is a very, very large financial industry sort of data collector. They do analysis on mutual funds, individual stocks, all those kinds of things. So like anything else, Morningstar feels the need to jump in and weigh in on everything. And if you know anything about Morningstar, you know that they came up with the style box. So there are 9 style boxes. These are market caps. These are large companies, mid-cap companies, and small-cap companies. And these are companies that are value, that are cheap companies. These are what they call blend, so core, something that would be like the S&P 500. And then these are growth companies. And just think of that, for simplicity's sake, low PE, market-like PE, price-to-earnings ratios, and higher than market price-to-earnings ratios. And why would you pay higher than a market price-to-earnings ratio? Because you expect that company, that stock, to grow faster than the market, which is not always the case. So the market cap right now, or the price-to-earnings ratio on Amazon right now is about 96. So basically, just mathematically, you would say whatever the price-to-earnings ratio is, that's the growth rate I would expect out of that company. So does anybody expect 96% growth, basically Amazon to double their business every year? Maybe like 5-10 years ago, but they're pretty big. So they'd have to keep buying more and more Whole Foods and all these other businesses. But so this was Morningstar's invention, and Morningstar, like any other firm that's dug into what they do, when smart beta comes along, they go, well, let's just fix it into kind of what we've already created. Let's get it into our framework. So they call this smart beta. Well, they call it, refusing to adopt the industry term, they call it strategic beta. So a lot of this stuff is actually market cap weighted. It's just they take the cheap companies first and then weight them by their market cap. So I know some of this is a little bit complicated, but anyway, my point is that's what they call smart beta. So they come up with this massive number, like $800 billion in smart beta. And I don't agree with that number. I think it's probably around half that. If you think about things that are truly designed to be different than the market. But so smart beta is, I would say, at the crossroads of what we've already talked about. So traditional active. So something that's trying to outperform the market, right? I put a bunch of definitions over here. So beta traditionally refers to market exposure. If I own the S&P 500, I have beta. I have a beta of 1. And I hate that term because that's not what beta means, but it's what the industry has adopted, so it's, for simplicity's sake, we'll stick with that. If anybody wants to spend an hour afterwards, I'll get on my soapbox and talk about why that's a horrible definition, right? If anybody here is involved with math, that's not what beta means, right? So traditional active is trying to outperform the market, do something better than beta, right? You wouldn't pay somebody a higher fee if they weren't going to generate something that was better. So traditional passive is just delivering the beta. That's Jack Bogle saying this is horrible, so just buy this. Just buy the traditional passive. Just buy the market, and you'll do fine. Smart beta goes, well, what if I can try and outperform the market without the guesswork? What if I can find certain characteristics of securities that over time are proven to do better than the market, and then get rid of the $10 million portfolio manager that, by the way, keeps guessing wrong, and we'll come back to that, and I just create an index that buys the same kind of, right? So I have an active manager that likes to buy cheap companies or growth companies. Well, what do I need the manager for? I can screen stocks. You go on Google, screen stocks for low PE, and you'll get like 20 online tools that come up and say screen stocks by low PE, right? So that's what smart beta says. Wrong button. I can do something in the middle. I can still try to beat the market, but I can do it by being passive to an index, right? I can be very quantitative in my approach. I don't need the guesser to do this. Does that make sense? I know I keep saying passive and index, and those are probably relatively new terms, but it's basically, think about it like, do I want a computer running my portfolio or a manager? I was at a conference in Chicago 2 years ago, 2 falls ago, and it was called Straight Talk About Smart Beta, one of the subsets. It was actually a Morningstar conference. So I went to sit in on this thing, and one of the panelists was asked, why is this better? Why is this smart beta an index that gives you something other than market exposure? Why is that better than having a manager going out and kicking the tires and seeing what's going on with Ford or Tesla or whoever it might be? And he said, because with this, every single day, I know what I'm going to get. Yep.
Don't you have to, though, in doing either choose to follow the, that value's going to be better in whatever run you want to use, long run, short run, or growth? I mean, you basically have to make a choice between one or the other. Am I following you?
Yes. So somebody would need to make that choice. I'm going to come, when I talk about factors, I'll come back to that, because my argument is don't make that choice. My argument is if you can prove that value and growth both outperform over time, then you would want to own both. You just don't want to own the middle, right? Because that's what dilutes the value and the growth. But we'll take a segue here if anybody wants to know what metric financial means. Metric is a way that you capture a factor. So to your point, well, let's just say we like value, so let's go with value. Great. How do you want to rank your stocks? By price to earnings, price to sales, price to cash flow, price to book. And if these things weren't in the way, I could list off another 10. And growth, should growth be fundamental growth, meaning companies who are growing their earnings? Should it be accelerating stock prices, right? All of those things are just metrics used to capture a factor. But yes, somebody does need to make that decision to say, I'm going to own something other than the market, but how do you arrive at that decision? And I'll come back to that again. Does that make sense? Okay. He said, I know what this is going to be every day. There's a computer generating it, and they'll always rebalance to the same thing. So if I've said I'm going to stick to my guns, I want companies with low price to book. The computer's always going to pick stocks with low price to book. The active manager, my analyst who covers Boeing didn't come in today. So we held on to the stock when we probably shouldn't have, or my dog knocked my coffee over onto my carpet this morning and now I'm in a bad mood and I'm selling everything and I hate Amazon, right? Get rid of that emotion. Get rid of that judgment, right, that can easily be clouded, and have a computer. So to your point, I've selected this thing as something that I want to do because I know it will do better than the market, but I no longer want a human in the way. That's basically what smart beta is. So it's designed to do a number of things. Reduce risk. So believe it or not, there are low volatility stocks. There are low volatility stocks globally this year. The global market right now is down about 5% this year. There are low volatility stocks that are up over 2 or 3%, right? So stocks with different characteristics matter a lot. Improve returns, momentum, that's a factor we'll come back to. Stocks that basically have done well recently will continue to do well in the future. That's a big return generator. Take excess risk in order to capture that driver of returns, and then generate income. I personally don't do a ton of work with that. The academics on dividends or yield as a generator of excess return over time is very mixed. And it actually generates a very high level of risk and is very highly correlated with value. As you might imagine, as a company's stock price goes down, its dividend yield goes up, right? And so there's very high overlap between cheap stocks and companies with high yield. In fact, some value managers use high yield as a measure of value.
So you said earlier that you were involved in some of this in your arena. What sabermetrics, to use a current term, make the unique choices about what is smart beta?
Yep.
And so you were talking about the big three, and now there's 8 of them, or 10 of them, or 12. There's a ton of them. Whatever. What separates, or what common things in terms of those unique characteristics make up that smart beta?
Yeah, that's actually a great question. So basically what you're asking is, how do you make the decision to go, right? I mean, I don't take calls from wholesalers, but if I did, JP Morgan wants to come in and talk about why I should use their value ETF and not iShares. And Goldman Sachs definitely does. Goldman Sachs has taken a huge bet on smart beta and their ETFs. Fidelity, the same, right? So one of the big keys for me with all of these firms is who's behind it. What's the academics behind this? So something I haven't touched on yet and is a little bit geeky on my end, and so I tend not to spend too much time talking about it, is what smart beta, and it was very soon going to move off the term smart beta and talk about factors. Factors are a very academic exercise. So the way I think about factors is I don't want JP Morgan's marketing department to come and tell me why their value factor is better than iShares. I don't want their Fidelity's marketing department to come and tell me why their momentum is better than iShares.
Isn't that subjective?
Well, it's not, because a lot of the firms don't have academics. So iShares, my former employer, has a gentleman by the name of Dr. Andrew Ang that sits over their factor investing department. He's a PhD. He's written a 600-page book, if anybody has a free time on Saturday, right? He has actually a very good writer. He makes it sort of human, sort of, for him. But very, very bright guy, wrote the book literally on factor investing. And so I know everything at iShares gets his stamp of approval. And by the way, there's a second layer at iShares. Everything that they do from a factor standpoint is indexed, remember I said everything on smart beta or factors has to be an index, is indexed by MSCI. Is anybody here familiar with MSCI? They're not as popular as Standard & Poor's, but they're an indexer, just like Standard & Poor's. Standard & Poor's is obviously very big with market cap weighted, the S&P 500. MSCI is very big on factors. My Bible is a 35-page research paper by MSCI, how they came up with DMF, which is their diversified multiple factor indexes, why they built it the way they did, the information ratios that help them decide which factors to include. So those academics are very important, but you're kind of touching on his point too. There's also some element of don't game this stuff. So I'll tell you, one of the things I don't like about JP Morgan is in a meeting from a previous life, we sat down with one of their product people and I said to him, what are the metrics that you use to capture value in your multi-factor portfolio? And he said, well, right now it's price to book, which is like the worst thing he could have said to me. I was like, what do you mean right now? And he's like, well, that gets decided by the folks on the active side of the business. And I said, so next year, if an active portfolio manager decides that price to earnings is not the way to go, it's price to book, you'll change the metric that you use to capture that factor? And he's like, well, he figured where we were going. He's like, yeah. And so that was the end of the meeting, right? So that's one thing that I really like about MSCI and iShares is, to your point, you pick a metric and stick with it. So companies with low price to sales will do well in very different periods than companies with low price to earnings. I mean, you can find all this stuff on Google, like companies with low price to earnings versus companies with low price to book. It's all out there, right? And they will do very different things at very different times. But if the academics, if the paper written by the PhD and not published on somebody's website, but in a financial journal, so folks like Carhart, does anybody know Fama and French? They wrote kind of the seminal work on value and small cap. They're behind a little company that most people don't know, but it's almost $1 trillion firm now, Dimensional Funds, DFA, down in Austin, Texas, keeping it weird down there. Right, all of that work is because Fama and French would tell you don't ever, I mean, they are very, very religious about what they do. Don't ever look at anything other than price to book. And actually, they'll make it even more complicated. They'll say, you don't want companies with low price to book. You want companies with high book to price, which is, okay, it's the same thing, right? You just made it more complicated for me. Go ahead.
Do any or all of these subtract out share buybacks? I mean, which distorts the numbers entirely? Yeah.
So that I just wrote something on, I don't remember if I put that in email or posted it on Facebook or both. So it doesn't. And that is
It doesn't distort the numbers?
No, it doesn't back out for those things. So, and that's part of what people don't like about some of these numbers is they're all based on accounting, which is this book, Schwade, says accounting is not a science, it's a state of mind, which I think is a pretty funny comment. But either way, when you make an index like that, it applies that uniformly across all companies. But share buybacks have been a massive, massive distortion, and I'm just making your point for you, in the market over the last few years. You've had very, very little earnings growth. And if you look at the revenue numbers for most of the companies that report, they're pretty dismal. But companies have very high earnings per share. And that's very different from earnings, is the point we're making here, which is Wall Street cares about what Wall Street cares about. And it's why I tend not to care about any of it. I don't like people who guess things. I published something on my Facebook page not long ago. There was a New York Times article titled, When Predictors Get It Wrong, Always. Right? I keep track of things that JP Morgan and Morgan Stanley say, and the S&P is going to be this and that by the end of the year. And by the way, they're all wrong right now. And they have 2 weeks for the market to bounce back by about 10 to 15% for any of them to be right. But you know how much they're all going to get paid this year? Multiple millions of dollars. A bad analyst on Wall Street is making $500,000 a year. So in any event, that kind of comes back to you just pick one and stick with it. Because if you know the academics support it and it's going to outperform over time based on the numbers that have been run, then stay with it. And that's the problem with Wall Street is people jump around. Well, this isn't working now, right? I mean, all the selling in Apple, I mean, a lot of that happens because portfolio managers go, I got to get this out of my portfolio. It's what we call window dressing in the industry. Or if a stock's going up, I got to buy this. I got to get this in my portfolio so when my prospectus comes out, then all the investors know that I owned that stock. Okay, did you buy it after it went up 60%? Well, that's none of your business, right? So,
When you do this, who does all the math? Is it all automatic? Is it all algorithms?
yeah, well, it's not algorithms. There's a screening process, so there's a little bit of a process to it. So folks at MSCI, and this is another reason I like them, and S&P has some of this as well, but MSCI is just, I mean, overrun by nerds. It's, people that...
But it seems to me there's a lot of math behind it. You've got to use them.
Yeah, so there's a PhD that runs the numbers.
And you're rebalancing every day.
Rebalancing every 6 months, sometimes every 3 months, sometimes annual. It varies from indexer to indexer. Almost all of the ETFs in my portfolios are rebalanced every 6 months, which I'm having that conversation with MSCI right now.
I think that's a long time.
It becomes very philosophical. For a single factor like value, momentum, or quality, or low volatility, I think it's fine. For a multi-factor portfolio, it becomes a little bit problematic. So I have a multi-factor global ETF in one of my portfolios, and it has, it's different from the market by about 5% this year. And I say different from the market, there's a term in our industry called tracking error, which is how different your returns look from the market. That's too high for a multi-factor portfolio, in my opinion. In fact, I just had coffee with the guy from MSCI about 2 weeks ago. He's a friend of mine from my days at iShares, and I said, I know you guys have run the numbers. I've been on calls about this before, but for a multi-factor portfolio, 6 months is a long time for things to drift away from their characteristics, like you guys should be thinking about for the multi-factor, making it 3 months. But to your point, there's a PhD that's going back and saying, well, let's look at the returns of companies with low PE, low price to book, low price to sales, all of those things. Finding out which ones are robust. I promise not to use the word T-stats, but there it is. They use data that has high T statistics, which basically tells you whether or not something is statistically significant, right? And then they work with the indexer to run the screens. So then the indexer says, I got it. I know what you're looking for. I will run the index for you. You tell me when you want the index sent to you. And then the indexer, every 6 months, 3 months, whatever it happens to be, sends it to a trader. And here's where all the cost savings come from. Now there's not a portfolio manager, there's a trader. Generally speaking, a portfolio manager will run 1 or 2, maybe 3 mutual funds. And that's why they're so expensive, right? If I'm paying this person $1 million, $2 million, I mean, I worked with portfolio managers that were making $20 million a year. If I'm going to pay him this much money, I got to charge that 0.75%. On an ETF that's indexed, I don't need a portfolio manager. I just need one trader, and that trader can trade like 10 different ETFs. And I can pay that person $1 million a year. Nobody's going to cry for that person where their next meal is going to come from. But it's much more economies of scale. So I learned something late in my career at BlackRock that surprised me, because the active funds make so much money, And a boss that I was working for went to a meeting. I'm a recovering active person. I spent the early part of my career on the active side. I've learned the error of my ways. He came back and said, you know something, I was talking with management today. iShares, the ETFs, are significantly higher profit margin than the mutual funds. And the mutual funds generate a whole bunch of revenue, but then you pay out these teams of portfolio managers and analysts and people that are sitting in a room reading a 10K or a 10Q and coming out and going, got it. Boeing's better than Lockheed Martin. So they buy Boeing. And then Boeing falls short on their orders, and Lockheed Martin kicks their you know what. And so that's a lot of the cost efficiency.
It still seems to me like these guys are just replacing the fund managers.
It's exactly what they're doing.
Yeah.
Yep.
They have some method and they stick with it and go.
Yep. So actually, great segue. So far, my slides have been pretty easy on the eyes. Bear with me for a second. I'm trying to show the difference between what you just said, how defined these processes are, and sticking with it. This is in a prospectus for a smart beta, actually a factor ETF that I use in my portfolio, Momentum ETF. The fund seeks to track the investment results of the MSCI USA Momentum Index, which consists of stocks exhibiting relatively higher momentum characteristics than the traditional market cap weighted parent index, the MSCI USA. The parent index includes large and mid-cap stocks as defined by MSCI. The underlying index is designed to measure the performance of an equity momentum strategy by emphasizing stocks with high price momentum while maintaining reasonably high trading liquidity, investment capacity, and moderate index turnover, each as discerned. A risk-adjusted price of momentum defined by MSCI is the excess return over the risk-free rate divided by the annualized standard deviation of weekly returns over the past 3 years, is calculated for each security in the parent index over 6 and 12-month time periods. The 6 and 12-month risk-adjusted price momentum calculations are then standardized at plus or minus 3 standard deviations and translated into an average momentum score. Does that sound specific? Does that sound like you know exactly what that fund is going to do for you? Here's the description of what the Global Allocation Fund Manager does. When choosing investments, fund management considers various factors, including opportunities for equity or debt investments to increase in value. Okay. How? How are you picking those things? This portfolio, 2014, had 26% cash. How's the stock market done over the last few years prior to 2018? Would you want 26% of your portfolio manager's allocation in cash? He thought stocks were overvalued and bonds were overvalued, and he put 26% of the portfolio in cash. And guess what happened to his flows? That was the side of the business I worked on. I ran active equity strategy for the US retail business, and there was somebody on the allocation side, and basically they put all hands on deck. Don't worry about equity, don't worry about fixed income, fix this. This was an $80 billion mutual fund that was bleeding about $800 million per month. They wanted very badly to right that ship. It's really hard to right the ship. How are you going to tell people, like, yeah, it's right to have 26% of your portfolio when there's nothing wrong with, and they couldn't even point to anything why they didn't like the market other than valuation. Anyway, I'll get back to it. So anyway, one thing's very specific and you know what you're getting. One thing's pretty vague and, you know, tomorrow you get flowers and cinnamon and whatever. So now that we've talked a little bit about smart beta, let's look at it with smart beta broken out. So we looked at these assets. We agreed active mutual fund assets are the Death Star. They own the world. Passive mutual fund assets, traditional market, S&P 500, that kind of thing. Smart beta, very little. ETFs, of the 5 trillion, almost a trillion, almost 20% of that now is smart beta. By the way, smart beta has really caught on in the last few years. So the fact that it's almost a trillion in ETFs is actually a pretty big deal. I'd like to see that accelerate, but I don't necessarily want it coming from here. I want it coming from here. And I would never wish for anybody to lose their job. I lost my job. That's how I left BlackRock, right? BlackRock every year, lay off 450 people. Eventually, your number is going to come up. But that said, something needs to change here. And that's where, in a couple of minutes, I'll probably start yelling more. So don't be offended. I'll try to smile while I yell. Why are ETFs better than mutual funds for smart beta? So we talked about this before. They're low cost. You pay one trader to run like 10 of them, not one portfolio manager and a team of 30 analysts to run 3 of them. There's a massive economy of scale. Because of the way they trade, you're not required to send out a prospectus every time somebody buys an ETF because it trades on an exchange. You're not buying it from the fund company. There's no administrative cost to sending out a prospectus every time somebody buys the ETF. So they tend to be very, very low cost. And again, because they're tracking an index. They're very tax efficient, again, for the reason I talked about before. So Vanguard has recently launched their factor-based ETFs. And at my old company, they came in to present them to us. And it was interesting. The company that I worked for had very little knowledge of ETFs, which I think is part of the reason that they hired me. And one of the things I asked Vanguard along the way was, well, is this going to be an active ETF, or an index ETF? And the guy said, well, they're going to be active. And he said it very sheepishly, like he was hoping that question was not going to come up. So an active ETF cannot do transfer in kind. They have to buy and sell securities just like a mutual fund, kicking off cap gains. So what does that mean for a momentum strategy? I'll come back to momentum. Very high turnover in momentum, kicking off tons and tons of capital gains.
So for an index ETF, is it just set on some type of index and you let it go?
Well, it rebalances every 6 months.
But you rebalance it, that's it.
So the ETF rebalances, and then I assume you're asking me for my portfolio. In my portfolio, I rebalance as well to make sure that things don't get out of line. But again, taxes are really important to your bottom line. So I try to be very careful to rebalance portfolios every 366 days because I want to make sure all gains are long-term gains, not short-term ones. But then there are also good indexers, again, for the reason I just talked about before. You're doing the create and redeem. You're not buying and selling securities. So that's why ETFs have kind of taken off with smart beta. They're a little bit higher turnover than your traditional indexes.
They're not like mutual funds because of the tax component. Are you working with like a pool of investments? And you're talking about transfer in kind, so there's no taxable event when you're transferring back and forth.
Yep.
There would be liquidated your Boeing when you purchased your
Yep.
laptop. So is that why you're working with them? I'm just trying to understand the pool that you're working with.
Well, so it's not at my level. It's within the ETF. The person running the ETF, when they have a redemption, so let's say you own the S&P 500 ETF from iShares. It's called IVV. That's the ticker symbol. And you say, I want to sell. So if you did that to a portfolio manager in a mutual fund, they have to go out and sell a bunch of stocks to raise the money to pay you because you've just redeemed your shares. The ETF manager doesn't have to do that. They can just deliver the basket of securities to an authorized participant, JP Morgan, Goldman Sachs, whoever it might be, and they'll deliver the ETF back to the fund company. So there's no selling of securities. There's this transfer of kind of basket of securities in exchange for...
Relinquish ownership, so it's not a taxable event.
Right. So they get rid of the basket of securities without selling them to anybody. They transfer it in kind for a share of the ETF. So it's a little unfair to mutual funds that they get that little tax loophole, but it's a very nice tax loophole that, by the way, again, almost nobody talks about. Did anybody here know that ETFs kick off almost no capital gains prior to just now? Right? Nobody talks about it. It's huge. It's massive. Some of these mutual funds, like anybody here get their 1099 for a mutual fund every year? Some of these mutual funds kick off like 10, 15, 20. I've seen them kick off 40% of their NAV, their net asset value, in a capital gain. You have no choice. You're not even selling the fund, and they kick you off a 40% capital gain. Anyway. So now we're looking at flows instead of assets, right? So we saw smart beta is a very small proportion of assets relative to traditional indexes. Now we're looking at flows. So here's mutual funds, dark blue, and the light blue is ETFs. I'm still trying to figure out what happened in 2017. I mean, mutual funds are just getting their you-know-what's kicked in terms of like flows. The only reason they're even positive is because people still buy fixed income mutual funds. So like a bond mutual fund or an allocation or a balanced fund, right? If I want something that's stocks and bonds, and I'll come back to this, but it's really equities where they're getting destroyed. And so I'll come back to it, but if you take active fixed income out of that huge blue bar in the middle, the numbers are just as bad as you would expect. And then right back to normal year-to-date, ETFs are eating mutual funds lunch again. So, like I say, things look to pick up in 2017. Now we're not looking at funds versus ETFs. We're just looking at categories. So it's all active, mutual funds and ETFs, all passive, mutual funds and ETFs, and smart beta, mutual funds and ETFs. So mutual fund flows, next slide. Mutual fund, active, passive, smart beta, you can see it all came from active, right? And on the ETF side, it came from all passive, right? I don't know why. Given what's going on in the active world, somebody would go launch an active ETF. They're doing it, but what a waste of time. Like all the things that you do in the mutual fund, you're just porting over to another vehicle. You're still going to underperform the market, which we'll come back to. You still don't take advantage of the tax efficiency of the create and redeem structure. You're still expensive because you have a portfolio management. Nothing changes except the wrapper, right? So you can take Brussels sprouts and put them in a Kit Kat wrapper, and when you open it, it's still Brussels sprouts and awful. Does anybody here like Brussels sprouts? Really? 2? Yeah. No, 3, 4? Ugh. The smell of them just, anyway. And kind of like active mutual funds. It's just the smell of them makes me gag, right? So that's ETFs versus mutual funds. You can see it's all passive in smart beta and ETFs. It's all active in mutual funds. But where is the money going? This is the key. This is why everybody wants into the ETF space, and they're launching very specific equity products. This is active equity. Active equity mutual funds, it's all ETF, it's all mutual funds. Down again this year, right? They are bleeding money. Bleeding money. You can see what's happening with passive equity. In fact, it's basically just walking across the hall. I mean, these numbers are almost mirror images of one another. It's leaving active mutual funds and going to passive, right? And here, you're actually even picking up some money from somewhere else. And it's going to smart beta and smart beta and smart beta, right? That's where the money is starting to go.
I need some help with the vision.
Yeah, so do I.
Light blue is?
This light blue is passive equity, meaning passive stock index, ETFs and mutual funds. And the gray is smart beta. By the way, look how consistent that is. That's the one thing that doesn't bounce around a lot. Up about 100 billion, up about 100 billion, up around 75 billion. Very, very consistent growth into smart beta. And then this is active fixed income, and this is passive fixed income. And again, the passive, more consistent. The active, 200 billion, 600 billion, 75 billion, right? It's kind of all over the place as people try and find out. And, we could, maybe set up another one of these sessions and talk about, get really nerdy on the flows around, even within the active mutual funds, how much money leaves the bottom performers after they've underperformed and goes to the top performers after they've outperformed. I wrote a paper on this at my old company, and it was basically like, you just bought all of the outperformance after it happened. So you can say I own 4-star funds and top decile funds, but you didn't own it until after they did that. And in order to buy it, you sold all of the underperformance after it happened. So the reason that that fund is a 2-star fund is the underperformance, and you owned all of that, right? So that's where the money is going. And you can see, it's funny, this exercise, putting this together with I don't have any help anymore. I used to have like all these people reporting to me, so now I do everything. And I've learned how to make little funky things like that happen in PowerPoint. I'm pretty proud of myself. Right? So why will this continue? This is what's happening in the industry. Forget about everything else. We just saw that almost all of this is happening in the equity world. Fixed income, active seems to be fine, allocation, all that stuff. These are the expense ratios, the average mutual fund expense ratios, according to Morningstar, which has, it's going to include almost all funds. The average expense ratio for a large cap value fund, over 1%. Large growth, almost 1.2%. Large blend, 1%. Small cap value, over 1.2%. So the market goes up 10%. How much have they taken off of your top before you even get anything? 10% of your return's already gone. Maybe that's why they struggle to outperform. So here's your performance. This is a huge study. If anybody wants to get really geeky, Standard & Poor's has what's called a SPIVA study. It's the Standard & Poor's index versus active. And basically every 6 months they keep track of what percent of managers are underperforming the benchmark. That's not, does anybody know who has anybody heard the name Standard & Poor's before? Almost everybody. That's a huge organization in the industry with a dedicated study to the underperformance of active mutual funds that we just agreed are really expensive. 1 year, 65% of large cap managers underperformed the S&P 500. 15-year annualized, 92% underperformed the S&P 500. Now, if there was an active mutual fund manager in the room that was running a large cap value or a large cap growth fund, they'd go, I don't care. My benchmark isn't the S&P 500. My benchmark is the Russell 1000 value or the Russell 1000 growth. I don't bench to the S&P 500. Granted, by the way, the numbers aren't much better when you compare them to their prospectus benchmarks. But if you're going to charge me 10% of my returns and you can't beat the thing that I can buy for 3 basis points, 0.03%, that I know what's happening to it every day, it's big, it's liquid, I'm going to go buy that thing, right? So, gee, why did $300 billion leave active equity? $150 billion, right? Why does that money keep leaving? Because you suck at your job, right? And you're not a bad person because of it. They're all great people. I worked, like I said, I worked with a lot of these guys. One of my favorite people in the world is about to retire, portfolio manager on a great fund. But you don't beat the market. You charge like anywhere from 0.8 to 1%, and I can do that way cheaper now, right?
Are you saying you can do it way cheaper an index fund or a smart beta fund?
Both. In fact, I would just say forget about the traditional index fund. I'll take a factor index fund, which is, we're going to shift gears here now and talk about factors, and I can do that much cheaper. So, and I have some numbers for you. In case you haven't, I put a lot of numbers in here.
Let's make it very clear.
Yeah.
95% of the indexes beat the active.
Yep. And that's exactly right. And he loves the SPIVA study. So what is a factor, right? So forget about smart beta. I'll call factors a subset of smart beta. That's not fully accurate, but for the purposes of index-based ETFs, we'll call it that. Any academically derived characteristic of a security that causes it to outperform over time. There have been hundreds of them researched by PhDs that have nothing else to do with their time. They're either bored in grad school or they're getting paid $500,000 a year by DFA or AQR or one of these firms to do the research. Go find out whether or not companies with low PEs outperform the market. Go find out whether or not companies with 6-month outperformance outperform the market. Go find out if companies with high ROE, return on equity, outperform the, right? That's what they go do. It's not a marketing piece. It's a PhD written piece that gets published in a financial journal. That's it. So back to, I forget who asked it, your point earlier about what can be in the portfolio. It has to have this academic work behind it. Okay. Data must support it across geographies and asset classes. So my answer, if somebody came and said cheap stocks do really well in the United States, but not in China, Brazil, or London, I'd say you found an anomaly, not a factor. You found something that just happens to work in one geography, but nowhere else, so it's not really a factor, particularly if you want to invest globally. And across asset classes, it should work in places like fixed income. It should work in commodities, places like that. There are tests to what we call robustness. Is it robust? Is it a robust factor? I call it the new active because guess what? I used to run for Smith Barney back before it was Morgan Stanley Consulting Group in Wilmington, Delaware. We did investment advisor research. So all the funds and managers that were available to Smith Barney advisors at the time, we vetted them. We did all of the research on them. And they'd have to come in and explain their underperformance or whatever their performance was. They had to come in and explain it. And you know what they'd come in and say? Well, we have a value bias. So we underperformed because value didn't do well last year. Or we tend to buy high quality companies. Quality didn't do well last year. I don't need you to pick cheap companies for me. I don't need you to pick high quality companies for me. I can screen for those things. There's almost no characteristic of a security other than maybe like a good management team, which by the way, ESG, does anybody know what ESG is? Environmental, social, and governance. So basically ranking stocks based on their, using a very broad term, responsibility. Are they environmentally responsible, socially responsible, and from a corporate governance standpoint, are they responsible? Right? So as I said, hundreds have been researched. Fortunately, there are about 6 that have broad acceptance. And what I mean by acceptance is, if you know anything about PhDs, they love to prove each other wrong. So a PhD publishes an article about cheap stocks outperforming the market. Every other PhD in the academic community is going to go run the numbers themselves and come back and tell that PhD why their numbers are flawed. And so what we find here is that you can't find a lot of holes poked in. Cheap companies do well, smaller companies do well. Momentum, companies that have outperformed recently will continue to outperform in the future. High quality companies and low volatility companies. There's a little bit more disagreement on that, whether low volatility companies outperform higher volatility companies over time. What we do know, regardless of the time period, they outperform on a risk adjusted basis. Meaning if I looked at what the return I got was for the amount of risk that I took, it was better than what I would have gotten from the market. So that's factors, that's why they're different from smart beta, because smart beta includes all this other stuff, like dividends, like market cap weighted things like growth, and all of these other things that, that Morningstar includes in there and we don't consider to be a true factor with academic support. Does that distinction make sense? Yeah.
What's the objective measure of quality? All the other ones I can see an objective measure. What's the objective measure of quality?
Yeah, so great question. Going back to, I think you mean metric, not measure, right? Just kidding. Yeah, so it's like anything else. It's like value. It's like momentum, right? Momentum, thinking about stocks that have outperformed recently will continue to outperform in the future. Over when? The last 6 months they outperformed? The last 12 months? The last 3 years? I mean, so quality, if you go back to the original work of, well, really original work from like Graham and Dodd, a PhD by the name of Carhart has done a lot of the follow-up research on it. Robert Novi Marx has done a lot of the follow-up research. The original quality metric is profitability. And again, as I mentioned, dimensional funds / Fama and French, they're very religious about what they do, and stop there. Don't look for any other measures of quality because they won't be robust, right? So gross profitability is, right, it's your gross sales divided by your gross expenses. It's just gross top line profitability. Other ones that others have vetted and found, much to DFA's chagrin, actually do support outperformance over time are things like ROE, return on equity, low leverage. So companies that don't have a lot of debt relative to equity or assets. But again, there's one that's actually ROE is a little bit controversial among academics because some of the original work done by actually a guy at BlackRock found that you should never use any metric for quality that's based on a bottom line number. So for anybody that knows what return on equity is, that's your net income divided by the equity of your business. And true academics say, don't ever base anything using a net income number because they're just accounting gimmicks. But MSCI has done a lot of work that's found that ROE is actually a pretty robust quality number. So why do I call factors the new active? Data and technology. This is why we don't need the active managers anymore. So I can take any mutual fund any of you own, put it into a software program, and it will tell me exactly what factors are exhibited in that fund. So I picked, this was, by the way, the portfolio manager that made $20 million a year. Great guy from Iowa. I went to school in Wisconsin. I love Midwestern people. Great guy, but you'd never know it. Short, little, balding guy that he's walking around making $20 million a year. Go figure. Good for him. And by the way, never traded a stock. His turnover in his portfolio was 2% per year. So people would go, what are you getting paid for? So basically the portfolio, it's an equity dividend portfolio. So he's looking for high quality companies that are growing their dividends over time, right? Mostly market. So we talked earlier about beta. Any portfolio that has all stocks in it is going to have high beta or sensitivity. That's why I hate beta as a term for the market. Beta actually means sensitivity to something else. If you have a beta of 1 to something, you track it perfectly. Below 1, you're lower volatility than that thing that you're tracking, and above 1, you're higher volatility than it. But anyway, you're going to have a lot of market exposure. You're going to, because it's all in the same asset class. And then lots of low volatility, and then some value, which, by the way, they market themselves as a large cap value fund. Well, crap. You don't have much value in your portfolio for a large cap value fund. Forget about that. Okay, so this fund costs almost 1%. The A share of that fund costs almost 1%. So what if I just took these factors, to your point earlier, somebody can just go buy these things. There is an index called, if we stick to the US, we'll call this IVV. That is a 4 basis point iShare that tracks the S&P 500. There is an ETF called USMV that's huge, very liquid, very tight bid-ask spreads that will track low volatility stocks. And there's an ETF called VLUE. There's a million value ETF, large cap value ETFs out there. So 98 basis points. If I take these percentages and multiply them by 4 basis points for the market, 15 basis points for value, and 15 basis points, 0.15% for low volatility, I arrive at an expense ratio, a blended expense ratio of 0.09%. Exact same factor exposures. So this is where I wish I was like a magician. I want to have like a little cape and like a top hat or something to wear. So we've just agreed those are the factor exposures, and I can shave almost 100% off my fees. I can shave about 92% off of my fees there by replicating that thing. Well, let's look at performance. Here's the BlackRock fund, 1995 to 2018. Here's the S&P 500, and it's outperformed by about 1% per year. So it's beaten the S&P 500. And we agreed that low volatility does better than the market, so that makes sense. Well, let's take this portfolio and check its return, right? And all I have to do is say I'm going to rebalance to these weights of these factors. I'm going to rebalance them quarterly and see how those indexes did over that period. Well, now the manager did worse, right? The manager underperformed by about 0.5% per year over that time period. So hopefully you're doing some quick math in your head. Of these three things, the fund, the market, and the factor portfolio, which did the best over that period? If the fund outperformed the market, but underperformed the factors did the best over that period and cost 0.09%. Right? So my first client slash friend, admittedly, I drove down to Baltimore to see him and his wife, and we got through all of this, and before I could finish the presentation, he said earnestly, "Why isn't everybody doing this?" And I went, "Stu, if I can get everybody to ask me that question, then I'll achieve my objective of taking that 25 trillion, right, and moving it to where it should be." So there are a lot of speed bumps to that. There are a lot of impediments. There's a lot of stickiness to that. How many people here contribute to a 401k, 403b, something like that? Retirement plan? You find a lot of ETFs in there?
No.
It's all mutual funds. And a lot of them are active mutual funds. And here's where you own active mutual funds in disguise. How many people here get, it's called a QDIA, Qualified Deferred Investment Alternative, Default Investment Alternative. That's a target date fund, like a Vanguard or a Fidelity. If it's not Vanguard, if it's Fidelity or T. Rowe or whatever it is, those target date funds are investing in active mutual funds, right? So how many people here heard that Fidelity came out with zero-cost mutual funds, right? Hard to miss. They're babbling about it all over the place. You think that's zero cost?
Probably not.
That gets a ton of assets for other Fidelity funds that are funds of funds, right? And if you want to buy it yourself, you have to sign up with a Fidelity advisor.
And you have to sell what's in your portfolio today to go there.
To go right there.
And therefore, you get the capital gains that come with it.
What a way to get quick assets. So any company that launches a new product, there is nothing on their mind, not performance, not cost, nothing on their mind other than speed of assets to that new product. That's all they want, is I want assets in there quickly, then I can raise fees, I can do whatever I want, but I want those assets in there quickly. And by the way, the Fidelity advisor that you wind up with, I promise you it's not a CFA. I promise you it's not a 40, 50-year-old person with a ton of experience, right? It's somebody that they hired for 40, 50 grand a year and will be gone off to their next job, their promotion, the following year. So I said at the beginning, my objective here is not to sell you anything, but to get everybody to think more critically about what's going on. So I just want to hit the last leg here. What? That's going backwards. No, it's not. I was. Okay. So we agree. Oh, sorry. So these are the returns of the fund versus the index and the factors. These are the returns of the factors. They're MSCI-based indexes. I haven't changed the numbers. Right? There's no wires. Sorry, I don't know where I came up with the magic thing just now.
I'm failing the eye test. Tell me again what the
Okay.
blue and the orange are.
So, and I meant to draw a circle here. I need to hire an assistant. This is a market-weighted index. So I know a lot of you don't know what this is. It's my most important benchmark. So think of the ACWI, All Country World Index, as the global version of the S&P 500. It's just a global basket of stocks. So this is the All Country World Index. This is that index reweighted for momentum, value, quality, low volatility, and small value. And not to make everything too much of a nit, the academics on small cap is actually that there's not a risk-adjusted excess return to just owning small cap companies. It's actually small cap value. It's cheap small cap companies that outperform over time, not all small cap, because there's actually an underperformance to owning small cap growth. This thing's going to take me out. So what you can see is all of these blue bars, which is returns, are all higher than this market one on the far left. But all the orange bars, except for low volatility, thank goodness, and quality. Quality has a very low volatility bias to it, as you might expect. When you're buying high quality companies, they don't tend to bounce around as much as higher volatility ones. But for momentum, value, and small value, you'll see the orange bars are higher than the market's orange bar too. So this is why factors have another name, which is called a risk premium. I'm getting an excess return for taking an excess risk. But the true test of robustness is when you take the excess return and the excess risk, when you adjust the return for the risk, am I still doing better than the market? And these are all the risk-adjusted returns. This is the market. You can see momentum, value just slightly, quality, low volatility, and small value. All of the returns and risk-adjusted returns are above the market. And again, to be clear, these are not like mythical beasts. These are things that you can invest in. I have portfolios that are built based on ETFs that track these indices very closely and very tightly without a lot of what we call tracking error.
That says 15-year, and that's through September 18th? Is that what that
Yes, that's through September of this year. So now I'll get off factors a little bit and I'll get less astonished by what's going on in the industry, but not by much. So what are the keys to success, right? Most financial advisors that I know, they don't love doing the investing piece. They like doing things like financial planning. Sarah and I were talking about this. You know, what's a good topic to invite people to? College planning, that'll get them. Retirement planning, like these are good buzzwords for people. We'll get them in the room and we'll say, I'll plan for college for you. I have financial planning software. I'll plan for retirement for you. I have financial planning software, all of those things. How do you get there, right? So I'm going to actually pause for a second. I know we're running out of time and I want to get everybody out of here on time, but a couple of thoughts. Number one, I couldn't have started my business without this company. I'm not going to say their name because I have some respect for them. But one of the problems that I had was, well, two things. The first video that they sent me was understanding RIA fees. I'm an RIA. I'm a registered investment advisor. I don't have a broker-dealer. I don't have MML or Edward Jones or Merrill Lynch or anybody like that backing me. I'm just out on my own. TD Ameritrade is my custodian. So anybody who has an account with me has an account with TD Ameritrade, and I'm just authorized to trade that account. So the video had a person introducing another person and the other person that got on, the first words out of her mouth were, "I want you all to know that I have successfully raised my clients' fees for the last 3 years." And I closed my computer. That's disgusting. In an industry where fees are doing nothing but coming down, you're taking great pride in taking more money from your clients. So what do they get for that? So when the S&P goes up 10, they lose 12% instead of 10% to you, right? So that's a problem.
No, but let's say she does very well. What if she does very well beating the S&P? Then she can charge those fees.
True. If you can find one that's beating the S&P that handily.
The S&P like 40.
So here, I'll put that back to you. Would you be willing to pay performance-based fees? Or if you were an advisor, would you be willing to accept performance-based fees?
No, based on their
So if I beat the market by 5%, you pay me 1.2%. If I underperform the market, you pay me 1%.
I'd think about it, yeah, why not?
So there's a company out there, a very large mutual fund company out there called AllianceBernstein. Recognizing what's going on in the active equity business, that money is leaving because of underperformance and fees, their idea was to come up with an active mutual fund that charges 5 basis points. And if they outperform by X%, they'll charge 50 basis points and on up to 1.3%. And if they underperform the market, you'll still pay 5 basis points. And so I wrote out this scathing email to our sales force, be ready for these questions. AllianceBernstein, nobody's worried about you outperforming the market and what you charge for that. They're concerned about the fact that you perennially underperform the market, and you're telling us you'll charge us 5 basis points. If you underperform the market, I can buy the market for 3. I don't need to pay you 5, right? And they never outperform. So that's kind of my answer to that. But my point is, if you're if you're a good fee-based advisor that's charging a fee based on the client's assets under management, if their portfolio does well, you do well. Your fee goes up when their account value goes up. So why do you need to raise the fee on top of that?
Yeah, because it comes out of their percent.
Right. That's my concern. Is right when everybody tells you that there's this shortfall, sorry everybody, this is the Dalbar study. Dalbar runs this thing every year, and they run the S&P 500 compared to investor returns. They basically go and look at flows in and out of equity mutual funds. And they've determined that over the last 20 years, ended 2015, there's a little bit of lag to this data, the investor earns about 4.5% versus a little over 8% for the S&P 500. So there's a 3.5% differential. And everybody runs around saying that this is because investors are bad. They buy high and they sell low. I don't agree with that. I think our industry does it to advisors. My mom is not running around going, hey, that fund was 90th percentile last year. We should get that out of my portfolio. The advisor is calling her and saying we should get rid of that fund, it's 90th percentile, right? I think there's a lot of bad advice that goes on. And by the way, the S&P 500 doesn't have a grandmother that fell and has to go to the hospital, right? You can't always control when you're taking money out of your funds and out of your portfolio, right? So, sorry, let me just, because we're running out of time. So the 2 components of investing success, and this actually kind of gets to your point, what you earn. So we just agreed, this is average large growth, average large value, average large blend, those are mutual funds. And these are the sort of replicatable factors. So momentum versus the average large cap growth fund, value ETF versus the average large cap value fund, quality and US minimum volatility versus the average large blend. So you can get more return, right? The first component, what you earn, you can get more by owning the factors instead of an active manager. We've agreed that they all underperform the market. And what you keep. So let's keep all things equal. 10% return on a $100,000 investment after fund fees, right? We just agreed that the average world allocation fund is 1.04%. So now that 10% return on 100,000, right, is $10,000. That is now under $9,900. So just from the fund fees, that's how much your gross return has dropped. I feel like that thing's, anybody ever see Seinfeld with the Kenny Rogers chicken? The light in his face, that's how that feels, just the white one. Right, so that's after fund fees. After your advisor fee, so the average advisory fee, and this is from a study done by, I have a source on here, Advisory HQ, the average advisory fee is 1.16%. So between those two things, you've lost 2.2% of your return, the fund and the advisor. And then there are platforms, advisors that work for Edward Jones, Mass Mutual, all of these types of companies. The platform, the company, has what they call a platform that they want all the advisors to work off of because then they can cover themselves legally. Well, we controlled the funds that they were using. And then the industry average for a platform fee is 0.25. A strategist that will put together the investment portfolio, like the company that I used to work for, there's a company out there called Loring Ward, there's a ton of them, will charge another 0.25%. But here's a lot of the reason I left my company and started my own. I went around to talk to all of these advisors, and they always used to say, like, geez, the fees really add up for my clients. I got to charge my 1%, and then Mass Mutual's taking their 0.25%. You guys are getting your 0.25%. And I'm like, hang on. Did you just tell me you're not doing the investments? You're hiring us, a strategist, to do the investing for you, and you're still charging one? What are you doing for the one? We're doing the investments. Well, I'm going out and building my business. Great. Finding new clients to charge 1% and not do anything for. Right? So, but if you think about it from the perspective of, well, there are things I can control in terms of what I keep, and there are things I can't control. Right? So I can't control the return. I mean, I can kind of. If I choose these things, the blue bars instead of the light blue bars, I can control it a little bit by selecting the right things. But the market's going to do what it does. So if the market goes up 10, and this momentum thing goes up 10.5, 11, whatever it might be, 12, in a good year, 14, momentum is an astonishing factor in an up market. It just blows the doors off of everything. But the return that I get, I have to be invested. So I have to accept some type of return. But what can I control? Everything else. Right? So I mentioned earlier, think critically. Right? So somebody referred me to an advisor. I went there. He is an advisor. She is an advisor. They have a sign out front that says they're an advisor. And they told me they charge 1%, and so I paid them 1%, and now I have a portfolio with them. They were nice. Great. Glad they were nice, right? So and by the way, it's, I hate to try and sound like Amazon or Tesla or whatever, but I am trying to disrupt an industry here. I am trying to make this fairer for investors. I think 1.16% is unfair as a starting fee. There is a gentleman, does anybody here know who Rick Edelman is? Okay. He now runs a company called Edelman Financial Engines because he bought Financial Engines. He's got $200 billion in assets under management. He's the largest RIA, registered investment advisor in the country. And he just lowered his fee for accounts with less than $150,000 in it from 2% to 1.75%. That was the starting fee, 2%. So forget about what the funds cost. The advisor has already taken, well, now it's 1.75. How magnanimous, right? So you can control those things. And the reason I say I want to disrupt the industry is because you didn't have a lot of choice. If you went to Joe Advisor in Simsbury, he was probably going to charge you 1%. And if you went to Ann Advisory in Avon, she was probably going to charge you 1%. And they were probably going to give you the same selection of mutual funds, and it probably boiled down to, who did I like more? Right? And that's who I wound up going with. Or who could I kind of poke and prod a little bit until they broke and said, well, I'll charge you 0.9% instead of 1%. So I'm trying to offer the third option, right? Something better than the 1% industry fee. The fund fees, we agreed you can fix that. The platform, the strategist, that all goes along with it. So I don't want to use like specific firm names, but I bump into them all the time at chamber events, and they all seem like nice people, and I just kind of, I want your business. I want to take all your clients from you. So it's, you know, we can chat and all that kind of fun stuff, but at the end of the day, if I bump into one of your clients, I know exactly where to go and what conversation to have. And I looked before I came down here. So before I do this, I'll just finish off quickly, just putting it all together. So we've already kind of touched on this, but these are all the active mutual fund average costs, and these are their equivalents in a factor-based ETF. So 1.05 versus 0.15, 1.13 versus 0.15. We kind of went through that before. But you're basically accomplishing the same or better things for a significantly lower cost. And then the industry, right? What are you being offered? Right? That's kind of what I was just talking about. I don't really have a lot of choice, right? Everybody charges 1%. Most of them don't act as a fiduciary. All RIAs are required to be a fiduciary. That means an RIA cannot do anything that's not in the client interest. We can't sell commission-based products. We can only charge fees. Right? And there's actually a legal obligation to do the right thing for the client. And these platform, I could do a whole separate on these platform approved lists. It's just such a massive money and asset generator for these companies. It's just off the charts. But what about the robo? Well, I can go do a robo. They'll charge me 0.25%. And that's great if you want to do it yourself. And you want a pre-manufactured portfolio that is dictated by the product companies that are selling into those robo-advisors. So whether it's Wealthfront, Betterment, whoever it is, iShares goes to them and goes, get us on your portfolio. Vanguard, same thing. I love Vanguard. They get kicked off of everything because they refuse to pay to play. Right? They just got kicked off of Morgan Stanley's platform about a year and a half ago. And Morgan Stanley was like, well, we had to make a decision about So you got rid of Vanguard? One of the best portfolio, gee, it had nothing to do with the fact that they won't pay you to be on their platform, is it? You're like, nuts. So, but read the fine print too. If you do use a robo-advisor, a Wealthfront, Betterment, or whatever, it's 0.25% until you want to call somebody and ask a question. Well, now it's 0.35. Well, now it's 0.5. Oh, you want to talk about trust or estate planning, whatever. Now it's 0.75. Right? So those things ratchet up pretty quickly when you don't just want to do it yourself. So just why metric? I promised Sarah I would keep the little thing at the end very short. So the things I would point out, before I came down here, I looked at a bunch of the firms in the area to see who publishes their fees. And I found one that published their starting fee, but no fee schedule beyond that. So it was kind of like, well, we start at 1% and we'll go down from there. Well, by how much and when? And why would somebody not publish their fee schedule? Because then they can charge you whatever you let them, right? So I have $1 million. I'll charge you 1%. I don't think I should pay 1% for $1 million. Okay, charge you 0.9, right? So having an actual fee schedule, no, your fee schedule says if I have $1 million, I pay this, right? And the reason, by the way, I have a very liberal friend in California that was like, well, why would rich people pay less than poor people? And I said, well, they don't. It doesn't cost the same amount or significantly higher to run $1 million account versus a $500,000 account. So do the math. If $1 million account is paying 0.65% and a $500,000 account is paying 0.75, the $1 million account is still paying a higher dollar amount. It's just a lower percent of assets, right? That's why the industry has declining fee schedules. So I publish all of my fees. There is a fee schedule there ranging from under $500,000 to over $10 million, exactly what gets charged on all of those asset levels. Hopefully we're clear that I know one or two things about factor investing. I do make portfolios that are pretty customizable for investors, so I build 44 different models, small accounts, large accounts, tax-free, taxable, all of those things. So whether you should be 80% stocks, 20% fixed income, or vice versa, 50-50, whatever it is, that's all part of the conversation. A lot of advisors are just kind of like, well, this is what I think you should do, so you're doing it. Oh, by the way, one of the big things, whenever we made a change to our portfolio when I worked for the strategist, advisors would get so upset, and we'd kind of be like, what are you so upset about? You keep doing these changes, and you're making me talk to my client. Well, they are paying you 1%. So individualized financial planning, network of financial professionals, so whether it's insurance, taxes, estate planning. Some people want me to do this. Not everybody does, but I will sit in on all of those meetings. If you want me to come to a meeting with a CPA or an estate planner, I will do that. Hopefully pretty clear, dedicated, and passionate. I'm not sure how red my face has gotten over the course of the last hour and 45 minutes, but I feel very, very strongly about this. I did this for investors. I started this company for investors. I know it's not easy to think about and do new things. But again, this is not a sales pitch. This is an effort to get everybody to think critically about what they're doing and what their options are. It's 7:45. Whenever I'm done talking, I open the floor to questions. I expect some of you, it's 15 minutes from my bedtime. No, I'm just kidding. Well, sort of kidding. Right, so if anybody has questions, let's throw them out. Most important screen, if you have questions and you would rather talk about them individually, there is my email address.
Funding for Simsbury Community Television is provided in part by contributions from viewers like you. Thank you.